Hi, Greg Weldon here with another episode number 7 of Money, Markets, and New Age Investing. And I'll tell you what, it is really crazy town out there, man. And we have a lot of really interesting things to talk about. First and foremost, disinflation and the upcoming Fed meeting. By the time you've heard this, and by the time we get to do another podcast, the Fed meeting will have come and gone. May 3rd, I believe it is, they'll be meeting to decide the next, potential policy move. The market, to some extent, is expecting a rate hike. That's what the financial media tells us. You could look at the Fed funds futures market. It's not saying a rate hike is 100% certainty here, for sure. So, in that context, I don't think it's fair to say the market is expecting. Certainly, Wall Street firms are expecting not just one more, but 1, 2, maybe 3. I saw an estimate yesterday for 3 more 25 basis point rate hikes at the next 3 meetings. There's some accepted within the academic / financial, brokerage community, financial media, mainstream, financial television. And you got to understand, all these people have a vested interest seeing the stock market go higher. So keep that in mind, number one. Number two, the expectation is 5.5. For some reason, they got in their head that 5.5 is the level that the Fed wants to get to. And you hear people on TV saying, we got to finish the job, get the job done, stay the course until the job is done. And we know that the Powell has been very specific about not wanting to stop too soon or not go far enough, and that the risk of that is greater, potentially, than the risk of going too far and being able to scale back a little bit. Of course, on the other hand, he says he wants to get restrictive and then stay there for a while. Well, that doesn't really allow much for the scaling back if we go too far, although, of course, they would. I mean, the evidence of the recent, as the bank failure where, outside of, as I mentioned on our last episode, outside of 3 weeks during the height of the pandemic in March and April of 2020, the week of March 15th, the week that you had the Silicon Valley Bank failure, that was the single largest weekly money printing by the Fed and Treasury in U.S. history. All right. Interesting to note that within the University of Michigan Consumer Sentiment Survey recently, the in 1 year ahead inflation expectations jumped from 3.6 to 4.6. And that's a big move for 1 month. It had been coming down steadily from above 6 to 3.6. And we may well see a 3 handle on CPI. We'll talk about that in a minute. But the consumer sees this. They know this. There's one bank fails. And all of a sudden, Janet Yellen's now, are we going to, backstop 17 trillion in bank deposits? We're not printing that much money. And if we do, gold will be $3,000 and a loaf of bread will cost you $50. But the degree to which that creates even more uncertainty and around the banking system. And then, of course, the question becomes, two questions. Number one, look how quickly the Fed turned on QT. They printed the most money in a single week ever, more than 2008, 2009, more than ever, save 3 weeks during the height of pandemic. That speaks volumes to the consumer who looks now at the Fed as, will protect the banking system at all costs, which of course they will do, even if that means acquiescing to a higher general rate of inflation. We told you this, the 40-year trend lower in inflation, lower in interest rates, lower highs and lower lows has ended. It's reversed. It is now going to be higher lows and higher highs. Sometimes I get that confused. I want to say higher lows. It's like so many times of, lower highs and lower lows. We get used to saying it. And it's almost, I've been doing this 39 years. I've been doing this during the entire downtrend in interest rates and in bond yields. In bond yields, interest rates, and in inflation. Seen the whole cycle. And now I'm telling you, it's turned. And the Fed will acquiesce to higher inflation, protect the economy, protect the consumer, protect the banking system. Because this is all well and good to talk about the Fed's going to hike again. And it's all well and good to say, monetary conditions aren't restrictive yet. Well, I have a thought on that I'm going to share with you in a minute. But before we get to that, we have to distinguish between monetary conditions, all right, and the things that the Fed, controls, monetary conditions, versus credit conditions, which is the banks and the bank lending of money, all right, and the degree to which banks now are scaling back. They're tightening their lending standards. They're going to be lending less money. We've already seen, a weekly decline in commercial and industrial loans. We've already seen, kind of the writing on the wall in terms of you've had immense growth, especially by the consumer, especially in credit cards, and borrowing the most money ever at the highest cost to borrow money ever. That's not sustainable. And it's done because of a diminished savings, that pool of savings that the Fed prints, $6 to $8 trillion, gives out, $3 to $4 trillion, and all of a sudden consumers have this huge pool of savings. At one point, the savings, the monthly annualized number on savings is one to watch, and it's a little volatile, and you have to know exactly what it means to understand exactly what it means, or how it's derived, I should say, and what it represents. Bottom line is, it was roughly, 1.3, 1.4 trillion, even 800, 900 million, throughout, kind of the last maybe 15 years up to the pandemic. All right. Then it jumped to 6 trillion. Now it's at a new low. It's lower now than it was before the pandemic by about, 20, 25%. So savings have been depleted to a great degree. All right. Your paycheck, wage growth is great, but when wage growth is less than inflation, your paycheck is worth less by the time you cash it. It buys less stuff. We know this. So what are consumers doing? The lower half of the income scale has been getting crushed. Prices for everything are going up. And what's interesting is you have disinflation now, and it's coming in energy. But before we talk about that and how it may affect Fed policy in the markets, let's point out one big caveat to this disinflation theme, which is coming. It's going to come. Inflation is going to fall. You could see CPI at a 3 handle. And then the Fed at 5 is going to be restrictive into a downturn in the economy. Why do they need to hike again? But in the context, to kind of get back to, in that sense of the consumer and inflation, and isn't it great that gas costs less? And food inflation is going to be sticky. That's a tough one, and that's around the world, and that's a whole nother issue. But we can talk about things like, energy, and we see disinflation. Last year in April, the price of a gallon of gasoline was $3.45 in the country. Last year in May, the price of a gallon of gasoline was $4.35. You had a massive increase in April and May, which will be, numbers that will be given to us a month later. So in the May report for April, and especially in the June report for May, you're going to see a big, unless you get a big rally in gasoline, which could happen. And I'm going to talk about that in a minute too. But if you don't get that, you're going to see a big disinflation coming from the energy sector that's going to push down the headline rate of inflation. But then I ask you, do you spend more money filling up your car with gasoline every month? What do you 2-3 times a month? Maybe. I don't travel much, so I don't barely ever fill my car up. But the degree to which people that commute, especially, all right, you fill it up 2-3 times, maybe it might even cost you as much as $100, at some point. And so $200 or $300 more a month. You pay more in rent. And when rent is running at one of the highest ever, 8.8%, almost 9% a year on rent. You're paying 9% more a year on rent is a lot, way more inflationist than it is to pay 50 cents a gallon less for gasoline. So, it's not like the consumer's all of a sudden going to have this, celebration because gasoline prices are lower. No, food is still higher. You basically go to the store, you get 40% less food. Not only that, here's the other one. It's a dual-edged machete cutting away at the legs of the consumers out there. Because I'm telling you, the foods that I eat, all right, specifically the one type of frozen pizza that I like as opposed to, ordering and waiting. If I'm on the fly or I just want to pop some in the oven real quick, frozen pizza. All right, I like Freschetta frozen pizza. I can tell you not only is the price gone up, but the pizza has been reduced in size by about 20%, maybe 15%, not quite 20. That might be an exaggeration, and I don't want to exaggerate. 15%. I have a picture. I actually put it in the Weldon Live, our research report, that shows the box and the pizza on top of the box and how much box there is left. They didn't change the size of the box because then when you bought it, you would know, right? No, they changed the size of the pizza. And the second I should have known when I grabbed it, out of the freezer in the aisle in the grocery store. But the pizza sliding all over the place in the box. That never happened before. And I'm like, what the hell? Does it break? I thought it broke. and maybe the two pieces were like sliding under one another or something because it didn't feel I had opened it. I couldn't believe it. And that's why I took a picture. I mean, really. I mean, not only that. Okay, the raw but frozen prepared chicken that you pop in the in the oven for half an hour. Right, Cordon Bleu. It is Barber is the brand. Right, the piece of chicken smaller, and they don't even now. Basically, what do you call it? Season it. There's no seasoning. The ways that these companies are saving money and yet still increasing prices, you're getting so much less for your dollar beyond the rate of inflation because they're cutting the size of the food. All right? So the Fed's going to hike rates into that? I mean, I feel like these are the things that actually are negative for consumption of discretionary items. And guess what? That's evidenced in the retail sales numbers in spades. I mean, we're talking, man, was that number really telling. But before we get to that, we got a lot to get to today. Before we get to that, we got to go back to this credit condition versus monetary conditions, okay? Again, consumers have borrowed the most money ever. A lot of that's been done with credit cards, most money ever, at the highest interest rates ever for credit cards, all right? And all of a sudden, the Beige Book, all right, the Fed is meeting on May 3rd. The Beige Book came out this week. It's now Saturday as I'm doing this podcast, okay? Saturday the 22nd, so it would have been 21st, 20th. So the 19th, this past Wednesday, the Beige Book came out. And one of the things says that customer traffic in stores is lower, especially in discretionary. Big ticket items, consumers are skittish, was the word, skittish. This is the Fed's own words. Skittish about making big ticket purchases, which the University of Michigan Consumer Survey also pointed out. The plans to buy a large appliance way down. All right. So the Beige Book's talking about this. Not only that, but customer traffic is down, purchase per visit is down. All right, and that people are opting for lower quality food choices. When you overlay the dollar spent on food against the dollar inflation on food, you can see that people are just buying less food for the same amount of money, or you're paying like 40% more. My daughter with a 3-year-old told me she can't believe it. She's like, every time you go to the grocery store, she literally kind of measured this because, she always listens to me talk about it. She's like, Dad, I paid 40% more for the same basket of groceries than I did a year ago. There's no pandemic anymore. There's no supply chain issues anymore. And yet this is still going on. I mean, food inflation in Europe and in many places is over 20%. Emerging market countries got as high as 30 in some places. It's coming down nowhere except India. And maybe we'll talk about that if we have enough time because we have so much to talk about today. The Beige Book is really interesting. It tells us banks are pulling back. Banks are tightening their credit standards. Consumers may be less willing or able to borrow money. These are the Fed's own words. Within the Beige Book, the 3 most used words, soft, softer, and softened. So what was my live on Friday? It was the Charmin soft economy. It's soft, man. I mean, that's what the Fed is telling us. The Beige Book, the Fed's own words, are the economy is soft, softer, and softening. All right. Then when we look at, retail sales, all right, now consider retail sales are not adjusted for price. So the price increase is the dollars spent. So if inflation goes up 10% and retail sales go up 10%, the actual volume of stuff purchased is zero in terms of the growth. There's no change because the entire change in retail sales is because prices went up by 10% and thus retail sales went up by 10% because prices were higher. When you take the nominal without even adjusting for inflation, without even adjusting for the inflation, sales in nominal terms down in every discretionary item on a year-over-year basis except eating and drinking establishments and online sales. All right. When you when you throw in the price adjustment, I mean, man, you're talking the nominal, the volume of purchases is really contracting sharply. I mean, I'm talking, each sector is a couple $100 million. I mean, garden supplies and building materials like Lowe's and Home Depot, $1.5 billion per month less than a year ago in dollar terms. All right. What are the ones that are contracting 2 months in a row and are now down significantly in dollar terms versus a year ago? Vehicles, furniture, electronics, appliances, clothing, building materials, garden supplies. All of the discretionary things, furniture, appliances, clothes. Come on, are we hearing this? Vehicles. In the meantime, even the year-over-year rate of change in eating and drink establishments has fallen, and actually, the outright number fell for a month. I mean, that's rare. So that's been the strongest place of growth for sure. And the Fed keeps telling us, okay, well, the Charmin soft economy is all well and good, but the labor market is, not soft enough yet. Now, if you remember, what I think I might have mentioned this last time, if you think about it, I mean, you're playing the Paul Volcker playbook, okay, which is 1978 to 82, when Paul Volcker faced the inflation from Clinton and from the OPEC oil embargo and the Iran hostage crisis and all the stuff that happened in the 70s, and then wage and price controls. Oh, my God, it was a mess. They didn't know what to do. They'd never seen this before. And Paul Volcker came in and raised rates to like 16%, 20% was the bond yields. I mean, it was insane. Right? What he did was crush the economy, bring inflation down. That is Jerome Powell's playbook. He's told us this since 2018. 11 white papers, 300 pages, published by the FOMC and the Federal Reserve in 2018, told us everything about what the new policy paradigm was going to be, and they did exactly what they said. They let inflation get above target. They didn't care how high it went. They were going to let it stay there because they knew they could hike rates dramatically to bring it down. The problem they didn't consider is in 1978 to 1982, we didn't have enormous debt in every sector, including the government. That printing more money was easy then. Reagan came in and printed a bunch of money, bankrupted Russia and brought the economy back. And all of a sudden, greed is good and Wall Street, the movie is made, I mean, you don't have that now. There's too much debt. You need growth to service the debt, or you have a debt implosion. A credit contraction would be the worst outcome possible. It would lead to a debt implosion, and that's it. Done. Over. That's what the Fed fears most and has feared most for the last really 15 years, since 2007. That's why they're so quick to turn around and print more money every time you get a problem. Because they know if you have a debt deflation, that would be the worst case scenario, worse than inflation. Either way, it's kind of debasement and the purchasing power of your money. Either way. That's why it's important to do the things we talk about doing in terms of investments, because everything's changed. All right? What do we have in terms of the labor market? The Fed's waiting for the most lagging indicator to tell it it's time to turn. Well, by then it's too late. All right? And besides that, the labor market is loosening. The Beige Book was clear on this. Clear in how labor market softening, easier to find employees. Retention is easier. We don't have to pay bonuses this year to keep people. Not only that, but you also see the weekly numbers showing that, first you get the Challenger Gray numbers showing layoffs are up big. I mean, one of the biggest February layoffs we've seen in years, all right? And then the weekly numbers, the unemployment benefits, the number of people receiving unemployment benefits jumped to 1.8 million. It's much higher than it was at the lows. It's, still below the pandemic highs, of course. But it's moving higher at an accelerated rate, much faster than anyone was expecting. The number this week was much higher than expected, and it shows that more people are applying for unemployment claims again. All right. The Philly Fed survey was a nightmare. All right. You have a minus 30 reading on the headline Philly Fed Manufacturing Activity Index. Okay. And manufacturing, you get it. But services are coming apart too. So in this survey, minus 30 on the activity index, only 4 other times in history we've seen that. And it's a long-standing report. 1990, one of the worst recessions we had, 1991, Gulf War. 2000-2001 tech bubble burst, the 2008-2009 crisis, and the pandemic. Those are the only 4 other times. This is a recession reading, all right? And the Fed keeps talking about softening. Why do they keep using the same word over and over and over? Okay, there are a lot of synonyms for softening. And in my the Charmin soft economy, I mentioned some of the synonyms you might use. Exhausted, sapped, fragile, drained, powerless, impaired, damaged, susceptible, breakable, groggy, broken down, flagging, like that one, woozy, decrepit, injured, tender, paralyzed, frail, feeble, weakened, disabled, debilitated, delicate, wimpy, challenged, incapacitated, wimpish. These are synonyms in the Webster's Dictionary for soft or softened or softening. The one, you can even go as far, and excuse me if, someone out there is going to be offended by this, but I think it's a good analogy, all right? I mean, one of the synonyms for soft is impotent. Where is the Fed with the monetary Viagra, the monetary Cialis, when the economy is impotent, when the consumer is choking on inflation here? And inflation is going to come down. We know that, and that's going to give them some ability to move, but the markets are kind of priced that in already. Monetary conditions have actually eased. You see the dollar down. You see dollar versus gold down. You see gold up. So this is kind of interesting. How do you play that? Well, the UDN is the dollar down. We talked about that. The FXF is the Swiss franc ETF. That's a good one to own. All right. The CEW is the emerging markets ETF. That's a good one to own. I really like the Brazilian real. Why do I like the real? Because OPEC, Saudi Arabia, Iran, South Africa, Brazil, and China are all talking about a basket currency that would be fractionally backed by gold. Pretty interesting. There's a bill in front of Congress right now where Texas is asking the U.S. government's permission to print their own currency that would be partially backed by gold. I mean, it's a dollar currency backed by gold. Pretty interesting stuff. I mean, you could say that, people don't like gold. I mean, it's not a big ownership in gold right now. And frankly, you could say, well, if you look at the countries where you've had the highest inflation, those are the currencies that are strongest right now against the dollar, all right? Czech koruna, Polish zloty. I mean, CPI in those countries is almost 20. The disinflation is really rapid all of a sudden, and they're the strongest currencies, all right? Take a place like Spain. Spanish inflation went from 6.1 to 3.3 in the most recent month, 1 month. All right. In that context, at a 3.3 inflation rate, their inflation rate is below the ECB's refinance rate of 3.5. You have a positive real interest rate on a policy rate. I mean, India, inflation dropped to 5.6. It had been 9. All right. Dropped to 5.6. Bank of India, the Reserve Bank of India, the RBI, did not hike rates this past 2 weeks ago. They were fully expected to. The expectation is they get to 7%. 2 more 25 basis point rate hikes. One was supposed to happen 2 weeks ago. It didn't. All right. And what happens? Inflation falls, and they were right not to hike. Why? Because inflation is now below the policy rate by 90 basis points. The RBI is now tight, and they did nothing. They went from neutral to tight and had to do nothing to do it. The Fed's in the same position. But you look now at the situation in India where you have 151 basis point real yield. In other words, the bond yield at 7.25 is 1.5 percentage points above the inflation rate. You don't see that in many places at all across the world. In many places, it's still deeply negative real bond yields, including the U.S. Deeply negative, 5% inflation against, a 4-something handle on the 2-year note, for example. All right. But when you talk about this, all of a sudden you have a 7.25 nominal yield with a currency that's about to break out. The rupee looks really potentially strong here. Okay, the Sensex, the Indian stock market, looks really strong here. Chinese, same thing. Real strong economic data in China. All the sectors look good. The Shanghai Composite Index is about to break out. Even the U.S. stock market looks good. Why? Because the stock market's more correlated to the dollar than anything else. And the dollar breaks through par 82, and it's right there. That's going to be bullish for stocks. I think you have a rally in stocks in the meantime, in the short term. But to think inflation's gone, it would be wrong just because the inflation rates come down. All right. We wrote a piece, if you know my work, Godot, Waiting for Godot, famous play by Samuel Beckett, written in the 1940s, I think it was, where it's just 2 guys sitting around waiting for this guy Godot to show up, and he never does. And they sit around for an hour talking about, should we leave or should we go? Should we wait for Godot or not? That's the whole play. I mean, and there's a lot of, moral things and, messages and tells and, parables and, whatever worked into this. But, it was always like the Fed was trying to get inflation to 2% and couldn't for a long time. It was like, no, you keep getting this bouts of deflation, and inflation would go up because oil went up, but then it would come right back down, and you couldn't get it to 2 and get it to stay there. Right? And we keep saying that's waiting for Godot, waiting for Godot, waiting for Godot. Godot never shows up. Then in late 2020, early 21, I produced a piece called Waiting for Godot, the Alternative Ending, where Godot, a.k.a. inflation, shows up. And then you wish he hadn't bothered to show up. You wish he'd leave, right? Well, more recently with the Spanish and Indian numbers and a couple other places, you've seen big declines in inflation in Eastern Europe in particular. Poland, Latvia, Lithuania, Romania, Bulgaria, some of these places. Inflation's come down hard, man, 2.5 percentage points in a single month, dropping like a stone to some degree. And those are the strongest currencies. But in this case, I'm asking, is Godot left the building? Well, no, it's kind of a trick question because it looks like he's left the building because inflation is coming down. You get the base effect in the next 3 months. You're going to see low numbers in the U.S., and everyone's going to celebrate the Fed's victory over inflation. The problem is Godot has not left the building. He's hiding in the curtains, waiting to come out and shock everyone that he's still there. All right, why do we say that? Because of food, okay? Because of rent, and because of El Nino. We went from La Nina to El Nino the fastest I've ever seen, ever heard about, ever seen, whatever. Keep in mind that last year, 2022, according to NOAA, was the worst drought in U.S. history. Now, that may sound odd given the Dust Bowl, but when measured in land mass in the 48 continuous states, the amount of land mass out of the 48 states that NOAA had categorized as under extreme drought conditions was the most land mass in extreme drought ever in U.S. history. Okay. Now we're going to have an El Nino? Are you kidding me? You're already talking about radiation levels 40% above normal, emanating from, the Western Pacific, Western to us. All right. This puts a lot of food commodities at risk. Cocoa has screamed. I hope you bought cocoa. I think we talked about it last time. NIB is the ETF. Coffee also, JO. Cup of Joe, J-O. Sugar has taken off. Cane, C-A-N-E. I know we talked about that one. But you're talking about rice, corn, wheat, soybeans, a lot of different food. California gets affected. You're talking about produce and all kinds of things, nuts. You have no margin for error in these crops. And if you have a drought here in the U.S. and you have an El Nino in South America in the next season, you are going to be looking at higher food prices for sure with a lot of commodities in short supply. Round 2 of inflation. And that's when the stock market gets whacked. Let's talk about gasoline. All right. Maybe you get this space effect where gasoline comes down a lot. I think it will. I don't think you're going to see the same pop in gas that you saw last year. Having said that, it could be deja vu all over again. Why do I say that? Because over the last 8 weeks, you've had 8 weeks in a row of declines in U.S. gasoline inventories to the tune of 20 million barrels combined. You are at a deep year-over-year deficit situation in gasoline, especially on the East Coast and the Midwest, where they drive the most during the peak demand season. All right. And you're below the 5-year low when you're in a building period, a period where stocks should be building ahead of the Memorial Day, and they're not. This could be a big problem. The base effect could be a risk, and it could even be more so that you get the base effect, and then all of a sudden, whereas gasoline came down last year in August, September, you're not in August, September. Now, inflation kicks back in, El Nino's kicked in, and food is higher, and all of a sudden, now real interest rates are even higher. And the Fed may be cutting, and then the dollar's getting whacked, and commodities are going crazy to the upside. And you have a whole nother bout of inflation. That's when the stock market wobbles and breaks down. So when you play that out. Now, what's interesting about all this, in terms of trading, I still have a few minutes to go. So I want to get into trading. We are working on something that we're going to offer, as a product, a cheap product, a very inexpensive product. That involves, portfolios and stock selection sectors and, some of the quant work that I do, that ties in with the top-down macro. We want the macro, we want the psychology, we want the technicals, we want the quantitative to all meld together. Right? When you have supply-demand fundamentals that are one way and the technicals are the same way and the quantitative work is the same way, that's the Goldilocks zone for trading. All right. Now, what's interesting right now is we run quant for trends, all right? So I have a trend, what we call the trend momentum indicator, that we've licensed to certain institutions and, so, we're kind of working on this to get it so that it's really as valuable as it can be to people that, trade, to do their own stock picking and stuff like this, because I know a lot of people don't have commodities and, trading the ETFs is difficult and, trading on a twice a month podcast is almost impossible. But to give you some assistance on this too, and, to expand our business as well, but really about, just reaching more people in terms of helping people and want this to be right. So we're still working on it. And this is stuff that I've had, that I've used myself for my entire career. I wrote these algorithms in the 1980s and they work and they're phenomenal. And we're deciding how to best package it and show you what's what. But in doing that, it really amazes me where we are right now with the stock market, because we break down the S&P, we do the NASDAQ, the S&P, we do South Africa, we do Canada, we do Australia, we do Japan. We're going to focus on the S&P 500 to start because that's where everyone is. You take the 12 or 13 sectors, I forget which it is, that the S&P breaks down their own stocks into. Okay, so this is all S&P stuff that they do, all right? They break them down into sectors. We take the 500 stocks, then we take it by each sector. How many stocks are trending bullishly? Now, you can be in a bullish position but not be trending. Say the moving average is a certain way, the oscillator is a certain way. That would define that you're more bullish than bearish and you're not neutral. But then I want a trend that's strong enough to own it, because really risk capital is precious, man. You just, sometimes you want to take a flyer and sometimes you want to do some crazy things with low price stocks that might be an option on a commodity, like buy a cheap mining share that would go up if the metal went up and it's underpriced because they're not actually producing metal, but someone could, big mining firm might come along and buy them and all of a sudden you made some money. You got to do things like that too, right? You want to be doing a lot of different things. But the one thing in terms of your core portfolio is to, be focused on the things that are trending positively. Right? Trend following kind of got a bad name for a while there. And trend following to whatever degree, we kind of do it all. You want to be counter trend. I don't range trade, but these algorithms give us what are the range trading markets. When you want to be a range trader, here's the markets to trade. I always feel for people that don't do this professionally or can't be all the time, 24/7. You want to be, it's long only, and you want to be long the things that are trending higher. It's really simple, even though it's not simple to determine which stocks or which sectors. The idea, the theory, the methodology from its principle is really simple. You don't have to make this harder than it has to be. It's already hard enough. And what I'm saying is, within the breakdown of what's what, there's not a single sector where the sector ETF is trending bullishly. The amount of stocks that are trending bullishly in the S&P 500 is close to the lowest, if not in a bear market. In other words, if you're not in a bear market, you don't have a lot going on. You have the industrials, you have the information technology, you have energy, and you have some of the consumer discretionary. Now, what's interesting is 5 consumer discretionary stocks are among the 5 top bullish trends within the whole S&P 500. You say consumer discretionary, the XLY is getting wasted. How are the 3 stocks there among the top? Well, the 3 out of the 5, the top 3 out of the 5 are all home builders because of the way the XLY is created. It's not the XRT, which is the retail. Okay, it is consumer discretionary, and home builders. You buy a home, that's a consumer discretionary purchase to some degree. So you got to know the indexes too. This stuff gets it's not complicated, but it's complex. In that sense, okay, those home builders, they look pretty good. But I'll tell you what, some of the industrials and some of the infotech look really good. And these are mostly stocks that have looked really good since 2005, where they didn't get whacked so much in the pandemic, had some pandemic connection maybe, and in a continuing basis, all right? But what's interesting about this is that some of them have had such wild swings. The amount of money from low to high is enormous. Stocks are no more risky than currencies, than commodities, than anything else out there. They're just as risky, and if not more, because people don't think they're risky and because they don't treat them like they're risky markets. All right, I'm going to give you one example. I'm not going to tell you. We have 18 stocks, and I think I'm going to offer, what I'm offering you is basically a little write-up on these 18 stocks. It's not ready yet, okay? And I'm traveling next week, so this is something you want. Maybe we wait till the next podcast. I don't know. You can always email us at sales@weldononline.com. So I don't know how quickly I might be able to get this piece done because actually, again, I'm traveling next week. But bottom line is 18 stocks, and I'll tell you what, some of them look fantastic. They really do. But having said that, they also look really risky. All right, I'm going to give you 1 out of the 18 right now. I'm going to hold the rest back until I figure out how we're going to present this and then get it to you. All right, but one of them is basically Old Dominion Freight Lines. Stock is on fire. Okay, now this stock was a $4 or $5 stock for like its entire life until 2008. Then it started trending when the Fed started printing money. All right, in 2018 it got to $113. It actually sold off in 2019 because remember, from the fourth quarter of 2018 to the fourth quarter of 2019, the economy was coming off and the Fed was easing. Germany was in a recession, for crying out loud, for two quarters. All right. So then when the pandemic hit, this stock took off. It's a freight line, of course, and now this is a very much more valuable business. All right. It went from $76 to $373. All right. So basically it went up $300 in a year. All right. But the bottom line here is that it was then down to $230. So it lost $150 into 2022. Now it's back up to $381. Like the movements are all over the place, man. That's a lot of money. NVR is one of the top ones. It's a building company. All right. They've had 50% declines in the last 5 years. I mean, holy mackerel, And you're talking about, looking at, something along the lines to go back to ODFL, which is Old Dominion, freight lines, right? One of the things in the beige book, the Fed's beige book, was freight rates and freight companies. Didn't look so good. And this stock's near a record high. So it's like, okay, well, it looks really good technically, but do I want to be long something in the freight business right now? I mean, when freight rates are coming down and volumes are coming down, and we know this, I mean, shipping rates for container ships on the high seas have come way down. They're still not back to 2019 levels. They never will be. This is a permanent inflation in some respects. But do I really want to own a freight line, even though it's one of the best looking stocks and the best registering on the quantitative side stocks out there? These are the things you got to think about. In this age of polarization, it makes it much more difficult. You got to think of all these different things. And I'm going to put together a package for you. If you want it, sales@weldononline.com. And I will show you these top 18 stocks and what they look like and give you some thoughts on, why you might want to own them and why you might not want to own them, understanding that, I'm not a professional stock picker. I'm a professional trader, and I like to trade the indexes and the countries and the sectors, and it'll be long precious metals and stuff, and then we'll hone it down. And that's where we get the individual shares, and that's where we get this, which will help your portfolio once we get this product put together. And, I think this will really help you to try and keep pace, because you want to own the stocks that are performing. You don't need to own the whole 500. You will underperform and you will fall behind. And this is the case where, Old Dominion looks great, but do we really want to own a freight line right now into a recession? Maybe the Fed eases, that drives the stock even higher. Who knows? Anyway, all this and more on money, markets, and new age investing. Till next time, Greg Weldon, thanks for listening.